Indians are celebrating the equity rally, but in this noise, people aren't noticing that there is a continuing bond rally. A bond rally means government and companies are borrowing at far cheaper rates. Today, I have with me two experts, Suyash Choudhary from Bandhan AMC, who is arguing that government is going to borrow cheaper and cheaper structurally. There is a bond rally. And Piyush Gupta from CRISIL, who says that India Inc., that is corporate India, has also been borrowing much more cheaply than 2 or 5 years ago. Both are saying government and companies will continue to borrow even more cheaply. That is, the bond rally is set to continue. Now, why? That's what we are discussing today. And let me welcome Suyash and Piyush, who will be joining us in just a minute. Suyash, good morning. Thank you very much for joining us. Well, make your case first. Why do you think the rally is set to continue? We understood you could make a case why it has rallied, but why is it set to continue?
So, Latha, for any asset class to expand valuation, there are two conditions that need to be met. One, a solid narrative that supports incremental capital allocation into that asset class. And second, unlocking of more pools of capital that can be allocated to that asset class. So both need to be met, because you can have a very strong narrative, but if the same amount of money goes into that asset class, then everyone would like to be invested, but additional demand is not coming. And second, if you don't have the narrative, then you won't be able to unlock fresh capital classes. For India fixed income, our argument is that both conditions are being met now. So if you look at the macro narrative, it is well discovered. So I needn't get too into detail, but quickly, not all of that is cyclical. There are structural elements to our current account deficit compression, owing to a higher run rate on services trade surplus. There are longer-term triggers for fiscal consolidation, including greater formalization. And there is an RBI who is now well regarded as a macro stability and financial market stability targeter. So that's the narrative which both markets understand and respect, which is equity and bonds. Now, for the additional pools of capital that probably are getting unlocked for the first time in a very long time for fixed income markets. Now, traditionally, retail savings into fixed income used to be intermediated by banks, which is, you put deposits in banks and banks will go out and make investments, including in SLR bonds. More and more over the last 4 or 5 years, this role is being taken up more meaningfully by pension and insurance companies, which means that local savers saving pools are now more and more allocated into long-term government bonds. And it's a very powerful effect that we are now seeing over the last 5 years, where long-term money's allocation to outstanding government bonds has increased by a full 5 percentage point. The other very large pool of capital that is in the process of getting unlocked for India fixed income is global institutional investors. Our argument there is you are just scratching the surface at the $18-19 billion or $20 billion that you have received so far. If you see India's outstanding FPI participation as proportion of total government bond outstanding, it is just a shade higher than 3%. You will find hardly any other market at a similar scale where it is so low. Just for context, Indonesia, if I recall correctly, is somewhere around 15%. Pre-pandemic, Indonesia used to be 38% owned by FPIs. Not arguing that we'll go to Indonesia levels, but at 3.5%, we are truly very, very, very low on FPI ownership. And it's bound to increase, given that India is the 5th largest market GDP now, and a growing economy and a solid macro narrative. So bonds are fulfilling both these criteria of a solid macro narrative and incremental capital pools being unlocked. And we think that journey is very, very long and will continue over the next 3-5 years at least.
Okay. But Suyash, I'll tell you, there is one counter argument, or maybe a couple of them. One that, how much will Indian bonds fall from here? The expectation is that the RBI will maximum cut bond yields, cut interest rates, to 6%. There are not too many people expecting 5.75 and 5.5. Now, if it's only going down to 6%, if overnight rate is going to be 6%, then you don't see a 10-year going below 6.5, isn't it?
So, Latha, we are also in the phase of asset market discovery as far as bonds are concerned, and this is not just a rate cut cycle alone. So we respect the fact that RBI will cut modestly. Our own view is 575, but give or take, we are in the ballpark. However, the way valuation expansion will happen for bonds in our view is twofold. One is, as rates get cut, even though there may be minor steepening of the yield curve incrementally, it won't steepen very much, because you don't want higher risk premium for investing for longer. In fact, that trade is actually working in reverse, where you want to lock in for higher maturities given the India macro story. So that's one. We don't think the curve will steepen much as yields fall. And second way, valuation expansion can happen is, today India bonds offer the so-called real positive yields of roughly around 260 to 70 basis point versus forward forecasted inflation. Let's say RBI is at 410 for next financial year, and long-term credibility of RBI the way it is, you won't expect inflation expectations from a market standpoint to be greater than 4.5. This real positive yield will also compress, but both are relatively slow moving and will happen over a period of time. So there could be a cyclical stop to the fall in bond yields.
You're expecting what, 6% on repo?
Look, we don't have a number to that, but if 575 on repo rate gets achieved, then yes, 10-year bond could easily be in the early sixes, and we are still, reasonably, away from that. And bear in mind also that, market has still not made up its mind what kind of landing the West is going to have. That expectation turns on a dime. So we have gone from US, no landing to soft landing to hard landing back to no landing currently. And if, you eventually get a more than soft landing, then RBI will probably also cut to 5.5. So the way we look at the bond market is, the current cyclical narrative also is for repo rate to fall to at least 6%. The structural narrative for asset discovery for bonds is powerful. And therefore, the investment decision is only one way for us, which is to be long bonds, especially long government bonds.
Okay. Got that, Suyash. Now let me turn to the corporate bond market. Piyush Gupta, welcome to the discussion. Well, what we didn't know is that corporate bond yields have been falling, and even people are buying lower variety of bonds. That is, AA minus. Can you take us through this rally in corporate bond market, which seems to have gone unnoticed?
Yeah, I think what has happened in the corporate bond market, one is the spreads have shrunk. If you go back 5 years, the spreads were in the range of 90 to 100 basis points. If we look at current spreads, it's in the range of 35 to 45 basis points. I'm talking about AAA corporate bond benchmark securities. Even in the lower rated paper, if we see, there is a similar trend we observe in terms of narrowing of spreads. There's also another trend that we are observing is in the segment which is rated A and below, there's a good amount of supply which has come in the recent period. This supply has been sort of lapped up by segments like alternate investment funds, where there is a significant growth in terms of commitments being raised over the last few years.
Okay, but Piyush, there is also another problem coming. I mean, it's an eye-opener what you have just told us, that there is also greater issuance and purchase of lower than AA rated paper. This comes as a complete surprise that there is the share of unrated paper has gone up to 15%, your paper says. That's definitely an eye-opener. But what may be a dampener is that debt mutual funds are not getting as much money. See, up until 2 years ago, debt mutual funds had the tax advantage. But after that, they're not much better than FD, bank FD. So do you think that corporate bonds can suffer because of that? Mutual funds were the biggest buyers of corporate bonds.
Yes, I think apart from mutual funds, of course, there are segments like pension and provident funds and insurance companies. Of course, the demand for corporate bond in that space is towards the longer end. And that's where typically there is a challenge as far as provident and pension funds are concerned. Mutual fund, we have seen decline in terms of flows, but the recent trend show that there is some uptick with respect to flows coming into longer term debt funds, especially in the last month that we saw. The expectation of rate cut, decline in yields can possibly spur some growth in the longer term corporate bonds in the that, of course, there is also there are a number of launches that are happening in the target maturity funds. It was something which had seen a bit of slowdown post the tax changes, but there is some uptick that we are seeing at least in that space also.
Oh, you're seeing some uptick. Suyash, a similar question to you. You would know even better since you are managing the CIO of a mutual fund. Do you see this as a major dampener that debt funds are not getting as much money and so, corporate bonds will not be purchased? How do you see the future trajectory of corporate bond yields, not just government yields?
So, Latha, first on debt funds, I agree with Piyush. There is some expansion of footprint that is now happening. So, year one after tax change, it was also volatile fixed income markets. And therefore, a lot of allocations were happening only to the very short end, which is overnight liquid at best money market funds. We are now beginning to see, more allocations also into short, medium duration products, as well as active duration, also long duration products. Although, like you observe, the quantum of flows would have been much better had the tax change not happened. Secondly, debt mutual funds themselves are innovating new products helped by incremental, leeway being given by the regulator on new asset classes and such forth. So basically, you have to solve for around 100-150 basis point loss on taxes, which you have new product categories to probably cater to. And third is, new and other investor classes are also emerging. So private credit in India is now coming up. FPIs, as they get more comfortable with the bond market, will also want to look at more high yielders. Some sense there is already some demand there, and therefore, the rub off of the sovereign rally will of course happen on corporate bonds. Although we would expect corporate bond spreads to widen somewhat, but that won't come in the way of corporate cost of borrowing falling. So we expect sovereign bond yields to fall faster than corporate bond yields, but that doesn't mean corporate bond yields won't fall. It's just that spread would widen somewhat. So the discovery process for India assets is not just restricted to sovereign, although the bulk of the benefit will happen to sovereign. It would also percolate to other fixed income sub-asset classes.
So what is your expectation in terms of corporate bond yield? How much is it falling over the next 2-3 years, and by how much?
So the one challenge with the corporate bond curve is that it's inverted. Right, so the front end up to 2 years is higher than 5, 10, 15 years on account of the credit to deposit ratio challenge that banks have faced, which is leading to higher, rates for deposits and therefore CDs as well. We expect over the next few months, as the CD ratio stabilizes and RBI wants to ensure transmission of its rate cuts, this issue will get solved and the corporate bond curve will become flat to steep. However, that limits to some extent the long corporate bond rally, because the first move will be the curve flattens and steepens and then a rally starts. So our sense is at the long end of the corporate bond curve, the spread would widen, but absolute yields will still fall by, whatever 25-40 basis points over the next 1 year or so would be my guess.
Okay. Well, we have to wind up on that note, out of time. But Piyush and Suyash, thank you very much. That's a very important trend that you are pointing out to even the equity investors, that there is a downswing in the cost of borrowing of India Inc. and of Government of India. That's a lot of positive. It could mean a rating upgrade. It could mean a structural fall in the cost of capital for Indian governments and corporates. We'll wrap up on that positive note on Bazaar. Chart Past is coming up.